see. Okay, very nice. Testing, testing, 1, 2, 3. Hello. Okay, testing, testing. Can you guys hear me? Just a quick check before I begin the webinar session. Those who are in the webinar, can you guys type in the live chat to see if you guys can hear me? Alright, and can you see my screen if it's clear enough? Alright, let's maybe wait for a few more minutes before we begin the session. Alright, okay, great. Now that you can see my screen and hear my voice, give me a moment. We will begin before we will see if there are other people joining before we begin the session officially. Alright, so just sit back, relax, and we will begin the session in a few minutes time. Alright. Okay, let's begin the session. Give me a moment. Alright, so let's begin. Alright, before I begin this session, today's webinar is on the 7 common mistakes new traders make. Alright, and before I begin the session, let's go through the disclaimer. So this is the disclaimer. Remember that everything in this webinar is educational in nature and nothing should be construed as investment or trading advice. Alright. So these are the topics that we will cover today. So the first section will be not having a trading plan. Second one will be no stop loss or risk management. Third will be revenge trading or over trading. Fourth, revenge trading is third. Fourth is over trading. And lastly, we will be going through the most important part, which is not keeping a trading journal. Alright, so I'm your host for today. My name is Woon Hong, and I'm an investment analyst for Everest Fortune Group previously. And today I will cover this topic on 7 common mistakes new traders make. Okay, so firstly, not having a trading plan. So there are certain key points to take note of for this first section. So firstly will be consistency. So a trading plan helps you maintain consistency in your trading approach, and it outlines your trading strategy, including entry and exit criteria, risk management rules, and position sizing. Okay, the second part will be objective decision making. So a trading plan provides a framework for making objective decisions, and it helps you define specific criteria when you enter and exit trades based on either your technical or fundamental analysis. This eliminates guesswork and emotional biases, allowing you to make rational decisions based on the rules that you have. Third will be risk management. So a trading plan incorporates risk management that helps you to set your stop loss orders and when to take profits. So by implementing proper risk management, you can limit your potential losses and preserve your trading capital. Fourth would be focus and discipline. So a good trading plan keeps you focused on your trading goals and prevents distractions, and it helps you avoid impulsive trades. You have set avoid impulsive trades or chasing after hot tips, right? Following a plan requires discipline and adheres to the rules that you have set for yourself. So the next one would be evaluation and improvement. So a trading plan serves as a reference point for evaluating your performance. So for example, if you keep a record of your trades and compare them to your trading plan, you can identify strengths and weaknesses in your trading strategy. So lastly would be, of course, confidence. So a well-defined trading plan gives you confidence in your trading decisions, and it provides a structured framework and a set of rules to follow before you enter a trade. You are more likely to stick to your set of rules during challenging market conditions and avoid making impulsive or emotional decisions. Okay, so it is very, very important to have a trading plan so that you know how you are able to tackle the markets on a weekly basis. All right, and then you can build confidence from there, because from my experience, if you have a good trading plan, you'll be able to follow your own set of rules, and to once you follow your own set of rules, you will avoid entering impulsively, and then you can profit in the long term. All right, so secondly will be having no stop loss. So this is the anatomy of the trade, right? Firstly will be entry, stop loss orders, take profit orders, and then break even, partial profit, ideal invalidation, trading stop, and also diversification. Okay, so let's go through the trade management first. So why trade management, right? So firstly will be controlling of risk. You can limit potential losses and manage overall risk exposure. Okay, yep. Secondly will be to maximize your profits, lock in profits and maximize returns. Third will be managing of your emotions. And fourth, improving your trade efficiency, meaning how often are you able to enter a trade and profit in the long run. Okay, the lastly will be increased consistency, helps traders to achieve consistent results over time by reducing the impact of individual losses and maximizing the impact of your winning trades. Okay, so let's go through this issue with fixed TP. Okay, so what is a fixed TP? Basically, you have a very clear resistance over here, and this is a very strong resistance here. Price has reacted off it twice. This is the first time and this is the second time. So imagine if our strategy requires us to have a fixed take profit of 100 pips, meaning from your entry point to your take profit, you just calculate 100 pips. If it is exactly about roughly above the resistance area over here, this will place the target beyond this strong resistance area. So we are expecting from price to go up from here after the breakout, right, all the way up to this strong resistance level. So let's see what happens next. So price reached close to the very strong resistance over here, since it is our profit target, right? But after shooting up, it missed by a couple of pips before reversing back down. Price tends to reverse off big areas of resistance and support. Hence the reason why price didn't break through this area, even though it has run about 90 plus pips. And if you have a fixed TP, and then you, for example, you went to sleep, right, and you forgot about trade, price will come all the way back down. Okay, so just a tip would be to place your TP before reaching this strong resistance area, because price often reverses off such areas of such key areas. All right. Okay, so the lesson that we have learned: don't blindly follow a fixed take profit target just because, for example, some signal provider or forum tells you to, right? Always look at the charts and adjust accordingly. All right, this is more flexible and it will help you to secure more profits in the long run. All right, so proper SL and TP placement. Okay, so let's say we have a let's see. Okay, so let's say we have a resistance level over here, and then we also have another level over here. All right, then if you are looking to sell towards this level of support, right, your take profit should be before this level of support rather than putting it on the level of support right here, because if price comes all the way down here, it is more likely for price to bounce off this area, this level over here. For example, if you have like a very strong demand zone or the block right here, it will just bounce off before breaking through this area. Alright, so your stop loss should be beyond the resistance level. Okay, if your entry is right here, your take profit should be before and your stop loss should be beyond. Right, it gives price space to breathe, right, because you don't want to get stopped out too easily. Okay, so next will be trade management with Fibo confluence. Okay, so let's just go through this. So let's say if you have a buy entry right here, okay, and you have a Fibo confluence level, your stop loss should be beyond the Fibo confluence level, and then your take profit should be before another Fibo confluence level. Alright, because as mentioned previously, always put your take profit target before a big Fibo confluence area, because it is more often for price to reach close to that level and not on that level itself. Alright, and then your stop loss beyond, because we don't want to get stopped out too easily. Okay, so another problem, if let's say you have your fixed TP or fixed stop loss, alright, for scalping I would say it's still okay, but for swing trading, right, you shouldn't have a fixed stop loss. You should be flexible based on the market conditions. Okay, so let's say we have a level right here, we buy thinking that price will go all the way up to take out liquidity over right here. Okay, but from experience, price would show rejection over here and also around this level over here. Okay, but following this is just an example. Okay, so we buy over here, right, and our strategy has a fixed stop loss of 100 pips, which is right above the nice support level over here. Okay, remember this is above, right, so our stop loss should be beyond instead, correct? So price goes down, touches your stop loss and bounces perfectly, right? I'm pretty sure this is familiar to all of you, right? Your stop loss should be beyond this level of support right here. Okay, because price has more has a higher possibility of bouncing off on this support level rather than beyond. Alright, so we should extend our stop loss level and not put a fixed stop loss of 100 pips. Okay, so always be flexible and adjust based on market conditions. Alright, so price tends to get attracted to key levels of support or resistance and bounce off them. So you should place your stop loss slightly beyond a key level of support or resistance. Alright. Okay, so dynamic SL placement, right? So this is the opposite of fixed stop loss. So it is used to manage risk in which the stop loss level is adjusted dynamically based on market conditions. So the level of stop loss is continually moved to a more favorable position as the price of a asset moves in the desired direction. So for example, your trading stop loss, right? So each time you profit, you move to a another level. Alright, so the goal of a dynamic stop loss is to lock in profits while minimizing potential losses. Okay, so this is your trading stop loss. So let's go through this. So let's say you are looking at a entry right here. Okay, so which is at a level of 100% Fibonacci projection. Alright, and then you can see there's this minor level of resistance support that turned into a resistance right here. Okay, so we can see that price might reject from here and come down to this level of support. Okay, so your stop loss should be placed above this high right here, right beyond the level of resistance, which is correct, and your take profit should be at this swing low support level right here. You can place it slightly above this swing low support also. Okay, so we can see that there is a negative 27.2% Fibo expansion over here, and also a 61.8% Fibo projection at this level. So we should place our stop loss slightly above this level over here. Okay, so price is currently testing the 87.819 level at this asset, okay, at the entry. And your stop loss should be placed beyond the feeble confluence area instead, right? So let's say we initially we have a level of stop loss right here. Now we are changing our stop loss to slightly above the feeble confluence area just in case. Okay, so let's see what happens, right? So price from our entry, price broke through all the way up, even broke this level of resistance right here. And lucky enough for us, right, we placed our stop loss above this feeble confluence level right here, and price went back down all the way to our entry and even profits after that, right? If we have placed our stop loss previously right here below the feeble confluence level, we would have been stopped out already. All right, so see, price went all the way down, reversed all the way to our take profit level. Okay, so this just proves that we should place our stop loss beyond the feeble confluence levels. Okay, so the next example would actually be this, right? We are looking at a level where we are where there will be a major pullback at this 78.6% feeble retracement level, and our stop loss will be placed above the previous high, which is all the way above here. It is this swing high resistance level, and our TP would be at this, either this low or all the way at this low right here. Okay, so let's see what happens. Right, price has hit our entry and has reversed nicely off of it, heading towards our TP. All right, so we can also draw where should our TP be. Our TP shouldn't be at the wick over here. It should be at a key feeble level or slightly above a key feeble level. All right, so our TP should be placed at this 78.6% feeble retracement level, because there would be a high possibility that price might reverse at this 78.6% feeble retracement level. So you should place your TP slightly above this 78.6% feeble retracement level. All right, so we can see right here, price literally came down, touched our 78.6% feeble retracement level, and reversed back off, right? If you place your TP right at the wick of this level right here, price wouldn't come all the way down. All right, so this is just a tip for you guys. Okay, you can see over right here, price came down, touched this level, and went all the way back to our entry as well as our stop loss. So if you imagine, if you held the trade all the way, right, you will have either hit break even or hit your stop loss. Okay, the next example will be this. So we are entering a buy entry, right? Our stop loss, our entry will be this. Our take profit will be the negative 27.2% feeble expansion level, as well as the 127.2% feeble extension level, because there might be a possibility that price might reach there and then start to come down to retest this level of breakout, right? Because we have broken out of the descending trend line and we are looking to enter off the breakout. All right, then your stop loss should be placed beyond this low right here. Okay, so let's see. Let's see how this plays out. Price went all the way up. Since we put our TP placed above the confluence area, price reversed off it and missed our TP by a few pips. So as mentioned previously, we should place our TP slightly before the feeble confluence level, because price might not break out of this feeble confluence level right here. Okay, so just to take note of that. Yep, so if we have placed our TP below the confluence area, price will have hit our TP nicely before it reverses. All right, so this helps us to eliminate such losses, right? It will be a waste if price actually hit our TP initially and reverse off of it, right? So just a key thing to note: always place your TP before a important level. All right. So the third thing to take note is that another mistake that new traders make would be having no risk management. All right, and also revenge trading or over trading. So once a trade reaches a level where the trader has neither made a profit nor suffered a loss, it is called break even. All right, so break even, I'm sure you guys know the term already, right? So let's just go through it pretty quickly. So let's say we have a buy entry on a breakout, hoping for price to push to our take profit target over here. All right, so let's say we have entered over here. All right, then we have our TP over here. Okay, so imagine we have our take profit target over here. Then our original stop loss would be, let's say, either at this low or the major swing low over here. Okay, and price starts to bounce all the way up here, reaching this level of high. Okay, and then we shifted our stop loss to our previous entry point, which is over here. So price came all the way up before reaching our take profit, came all the way back down to our entry. All right, so we got out of this losing trade at break even. Okay, so because we have modified our stop loss, and hence we have gotten out of the trade at break even. Okay, very simple. So partial profits in trading refers to the practice of closing only a portion of a trade when it reaches a certain profit target, while leaving the remaining position open in order to potentially capture further gains. Alright, so usually what you might have seen from, let's say, signal providers or your own trading, right? Let's say you have reached your first take profit target, you have closed maybe 20% and let the rest run, right? And this helps to secure some profits before the trade hits your break even, right? So this helps you to minimize your losses and also to maximize your profits. Okay, so let's see the partial profit example, the first example, right? So let's say we have a level right here, okay, and then we entered a buy, right? Because we see that price has been rejecting this overlap support level multiple times, and our first partial profit will be taken at the 38.2% Fibo retracement, as well as the 78.6% Fibo projection level, because there is a possibility that price might come all the way up here and then reject down after. All right, so this is something that you need to take note of. So we expect price to rise to our TP, but there is a strong resistance right here. Okay, so once price reach this area, we should close 50% of our trade, or at least 50 to 70%, and let the rest run to our final take profit target. Okay, so as we can see right here, price actually rejected off this level of resistance. Okay, rejected off and starts coming back up. But by the time we have set our partial profit target over here, we have closed 70% of our position, and then we are letting the rest run. And then once you close, let's say 50% or 70% of your initial position, right, just shift your stop loss to break even, and then just go on with the rest of your day, because you have nothing to worry about already. All right. So this is our second example, right? We have our entry right here at this swing low support level. Okay, so this is our partial profit target right here, where it is a 23.6% retracement level, as well as a 38.2% retracement level over here. Okay, so yeah, let's see how this plays out. Okay, price has reached our partial profit target over here. All right, and then we'll be closing 50% of our trade and letting the rest run, shifting our stop loss to break even. All right, see, SL adjusted to entry to minimize losses. Okay, and right here, price actually went back down and came back to our entry, so we are out with 50% of our initial position. Okay, so moving on to ideal invalidation. So ideal invalidation is usually placed before your stop loss, so it is the level which you basically admit that your trade might go in the opposite direction and you should get out of the trade ASAP. Alright, when this level is reached, your take profit is then moved to your entry, giving you a small chance to get out at break even. Alright, so let's see. We have a sell entry over here, hoping for price to drop all the way down to our take profit target, right? Because imagine we are looking at a strong resistance level and you see that price has rejected this area multiple times, and then you want to take a sell entry, right? So you see that right here, price actually came down, right? And where should your idea be invalidated? So once price rejected at least 50% of this area right here, you know that you should shift your level to you should shift your right here, yeah, admit we are wrong, and move the take profit to entry. So this hopefully gets us out of this losing trade, right? So instead of your take profit being here, right, once price came all the way back up above your entry level, right, we are shifting our take profit to our entry so that we minimize losses. Okay, so basically, idea invalidation refers to the process of evaluating a potential trade idea and determining if it should be disregarded or acted upon. So for example, you have your initial trade idea. So the trader has an initial idea about a potential trade based off your technical analysis, right? Or maybe some indicators that you use. Okay, then we evaluate the idea, right? We evaluate the idea by looking at current market conditions and other relevant information such as your economic data, your news, etc., to see if the initial trade idea still holds up. So how about the invalidation criteria? The trader then establishes criteria for invalidating the trade idea, such as specific price levels or market conditions that would cause them to reconsider the trade. Also, for monitoring, the trader continues to monitor the market and the security in question to see if the invalidation criteria are met. If the invalidation criteria are met, the trader may choose to exit the trade or adjust their position accordingly. Alright, if the invalidation criteria are not met, the trader can then continue to hold the position or even add to it. Alright, I hope you guys understand the idea of this concept, idea invalidation. Okay, so let me show you guys an example. Right, so let's say we have a swing low support level right here. Price, it is still fresh, right? Price has not tapped this level at all. Okay, so we might look to see if there is a buy opportunity, right? And your take profit target is at least around the 50% mark of this whole move downwards. All right, we are at the 50% Fibo retracement, so we place our take profit target over here. All right, and we can see that we have a 127.2% Fibo extension level as well as the negative 27.2% Fibo expansion level. So this might be a possibility where price might come all the way down here. Okay, so we should place our stop loss slightly beyond there, right? Let's see. Yep, we have placed our stop loss beyond this level. Okay, and our take profit target right here. Okay, so once price reach this level, which is your 127.2% Fibo extension level and negative 27.2% Fibo expansion level, this is where we should invalidate our idea. Okay, this is where we should shift our take profit back to our entry if price ever comes down to this level, because there is a very high possibility that price might hit our stop loss if it comes down to this level. All right, so we can see right here, even though we have a buy entry, right, price came all the way down here, tapped this level, right, and since we have placed our TP at our entry right here, right, we are out at break even. Okay, so yeah, we are out at break even over here. Okay, if we have not switched our take profit to our price entry over here, price would have stopped us out, and we would have been out at our stop loss over here, which is quite a number of pips, which is about 120 pips. Alright, so you just have to be careful for that. Okay, so yeah. Okay, moving on to trading stop loss. A stop loss order that is set at a certain percentage or dollar amount away from the market price. So the idea behind a trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in the favor of the trade, right? So let's say you're in a buy position and then price is profiting nicely. So each time it profits, each time it reaches another level, right, you will shift your stop loss to maybe the support level higher and higher to lock in profits. All right, and then you can you wouldn't be worried about losing the profits that you have while the trade is running. All right, so this gives you a security. And but sometimes, in my opinion, it has its pros and cons. So the cons will be sometimes if, let's say, the trade is running very nicely, and if you shift your stop loss a little bit too close to the current price, right, price might actually take you out, and then let's say you are out at a certain number of profits, but there is a potential that price might be able to go up way higher, right? So you need to be careful of trading stop loss. Okay, so let me show you guys different methods of trading stop losses, right? You have your moving average, you have your parabolic SAR, you have different kinds of indicators that allow you to trade your stop loss, or you can do it manually, for example your key levels, etc. All right. So let's start off with moving average. So let's say we have a very nice sell entry over here. It's very simple. We are just using a breakout of this level of support along with the ascending trend line over here. Okay, so where should your stop loss be? Let's say you're profiting very nicely, right? All the way you have been profiting very nicely as price has been moving below this moving average. Okay, so each time price is moving very nicely, you can shift your stop loss to slightly above the moving average area. Okay, and let's say you held your trade all the way, right? And then you place your stop loss right here above this moving average because you want to lock in profits, right? So once price came down here, price went all the way back up, reverses. This shows a strong sign of reversal. Okay, and you're out at this level because you place your stop loss above the moving average. All right, so we got out before this whole strong bullish movement happened. So lucky for us, we have locked in quite a number of profits right here from our sell entry all the way down to this level right here. Okay. So we also have a trend line breakout, right? So we are not using moving average right now, we are using trend line. So we draw a trend line on, let's say, the H4 level or daily level. Then we can see a very strong descending trend line right here. So we place our stop loss above this descending trend line, and if we can see that price came out and broke out of this trend line, and we are out before this whole bullish movement happened. All right, so for parabolic SAR is quite similar to the MA as well, right? These are trend indicators. So we can see momentum indicators, right? We can see right here, same entry, sell entry, right? And then we are out before price broke out of this parabolic SAR. Okay. Also for the chandelier and ATR trading stop loss, same thing. We put our stop loss above these two red lines over here, meaning that if price came out to break out of these two red lines, meaning the momentum has changed and we are in a bullish momentum right now. All right, so this helps us to maximize our profits with trading stop loss, and you should put it at levels where it makes sense. For example, we have a resistance level right here, and if price has booked past this resistance as well as this chandelier and ATR indicator, price might become bullish. All right, so we are just trying to maximize our profits and limit our losses. So the good thing about using breakouts as trading stop loss, breakouts are usually high volatility events. All right, price can spike up and reverse almost as quickly. So a stop loss will help you manage risk and protect your capital overall, right? A trading stop loss can help you to protect the profits that you already have. All right, so you can see if you guys got used the let's say some expert advisors, right? Usually expert advisors would have trailing stop losses because they usually exit the trades for you, right? Just in case there are news events, etc. So if you guys have used the EAs before, for example, some EA that trades gold, right? Gold moves very fast and it has high volatility, right? By trading your stop loss for you, the EA is then able to lock in profits rather than incurring losses. Okay, so yeah, it's a good opportunity to learn from these EAs, right? Because it utilizes a strategy as well as proper risk management. Okay, so it can help you to understand the markets better as well. All right, so if you have a opportunity, you can maybe try using an EA and also to practice risk management on your side as well. Okay. Alright, so what do I mean by using breakouts as your trading stop loss? Right, for example, you are breaking out of a key level, right? We can see right here, for example, we have a buy level right here. Okay, so once price has broken out of this high or this orange line right here, which is another key level, right? We are shifting our stop loss to the key slightly beyond the key levels. All right, just one thing to note. If you have a key level, right, and price has broken out of that key level, don't place your stop loss on the key level itself, right? Place it slightly beyond the key level that it has broken out of, right? And then you can see how it runs, right? If you practice your risk management like this, you're able to maximize your profits in the long run. Okay. All right. So each time, let's say we have broken out of this level. Right, this is a level whereby price was once a support, now is a resistance, but price didn't respect this resistance right here. It has broken out of this resistance. Okay, so if let's say price is here, we will place our stop loss below the previous low right here. Okay, and also if price has broken out of these highs, right, imagine if price is right here, came up, right, broken it again, right, we will place our stop loss below this low, and then once price has broken past this level, we will place our stop loss beyond this low right here. Okay, so it is quite useful sometimes to trail your stop loss, right, but you need to trail your stop loss with precaution, because sometimes don't trail it too closely to current price, because you should trail it at proper key levels so that you avoid being stopped out. All right. Okay, so the next one would be if price, yeah. Okay, let's see. Okay, you can also use your MA as a reference. Okay, so let's say you took a buy over here, right? Or let's say, okay, it makes more sense to have a sell here. Okay, let's say, just imagine you have a sell position right here. Okay, once price has broken out of this level, right, then you should place a stop loss beyond this level over here. Okay. All right, so the next thing that I would like to tell you guys will be over trading, and also to not ignore your fundamentals. All right, so let's just go through it pretty quickly. Okay, so what is the FX news calendar? So it allows traders to see at one glance all important economic data releases, and also shows key events such as your GDP, CPI, NFP, and crude oil inventories, and even central banks' monetary policy meetings. These are all the red folded news. All right, as you can see here on the right side, we have CPI, core CPI, BOC, rate statement, Bank of Canada. All right, and then for the euro, we have monetary policy statement, as well as ECB press conference. So the ones that you have to take note of would be your rate folded news. Okay, rate folded news shows that there is very high volatility in the markets at that timing. Okay, and sometimes it shows all day, right? Meaning that it could be volatile for all the whole of that day itself. Okay, so these are some things that you have to take note of before you start trading, right? Always look at the calendar and see if there are any rate folded news that day to prevent yourself from being involved in trades that have very high volatility. Unless you're a trader that wants to take risks, right, that you can trade during those timing, right? But for myself, I tend to avoid such rate folded news unless there is NFP, right? Sometimes NFP, I like to, if I know that based off the previous data, right, I know that, let's say, gold will go up, right, then I would try to put a small position on gold, right, to see how it plays out. So understanding of high impact news, right, we have FOMC meetings. FOMC meetings will affect the USD currency a lot, which is your DXY index, right? I can show you guys some examples later on after we are done with this. Okay, then we also have the Fed interest rate decision, normally comes together with FOMC meetings. Okay, so if Fed is dovish, USD is bearish. Okay, if the Fed is hawkish, USD is bullish. Okay, if interest rate decision goes up, USD bullish. If interest rate decision goes down, USD will be bearish. Okay, and one thing to note is that if the USD is bullish, gold will go down. Alright, vice versa. Gold and USD has a inverse relationship. Right, so this is something to take note of. Not only gold, your Euro USD, GBP USD, etc. Right, they have a inverse relationship with the USD currency. Okay, so NFP. What is NFP? NFP, it measures the change in citizens that are employed from the previous month. So this excludes the farming industry, all right, and also unemployment rate. It measures the total unemployment of workforce that is seeking active employment from the previous month. Okay, so NFP and unemployment rate is one of the most volatile news for USD currency. Okay, just to take note of that. Alright, then we also have the crude oil inventories, which is weekly. It measures the weekly change in the amount of crude held by US firms. So if the crude inventories increase, meaning oil prices should drop. Okay, and also one quick thing to note, EIA, which is Energy Information Administration, short-term outlook, monthly forecast for the year ahead, the demand and prices across major fuel types. Okay, so this is just some information for you guys, for those that trade crude oil, like your WTI oil. All right. Okay, so yeah, benefits of using the FX calendar. Depending on your trading style, it helps you plan trades and allocations for the day, week, or even the month ahead. Alright, it's very good for day traders, and it also helps you to alert the trader of upcoming important news that might affect volatility. Alright, so as a beginner trader, I would suggest you to avoid trading on rate folded news days, right? Because it is very high volatility, and it will cause you to lose confidence if you lose too much on the day itself. Alright, so to build confidence, try to trade on days that have no news, or if you want to trade, trade maybe 15 minutes after the news, right? Close your trades 15 minutes before this important news, and only trade 15 minutes after the news release. Alright, so this is just two important key factors that you need to know. Okay, so last part will be trading journal. Okay, so setting up your trading journal, choose a format. Number one, right? Choose a format. Number two, decide on categories. Number three, capture your trade details, such as your stop loss, take profit, and why do you enter the trade, right? Fourth will be to analyze your trade performance, whether you did good on that day, whether you did bad on that day, right? And also to reflect on emotional factors. Like, let's say, did you overtrade? Did you trade more than you're supposed to that day? Alright, so number six, review and adapt, right? So let's say if your strategy is not working on Mondays, for example, right? Then don't trade on Mondays, trade on Tuesday, Wednesday, Thursday, etc. Okay, and lastly, to maintain discipline. If you have your own set of rules, always follow your set of rules and do not change your strategies too easily, because if, let's say, you tested your strategy for a few weeks and then you realize that, okay, your strategy is not working, but it might not be your strategy that is not working. It might be because you didn't follow your own set of rules and you traded on days that you're not supposed to, right? You traded on red folded news, etc. Right? Always try to test. Let's say you have a strategy that people say works, right? And then you try it and you find out that it doesn't work, right? Because sometimes these kind of strategies don't always work for certain individuals, right? You have to learn more about your supply and demand, right? It's a good thing to learn about fair value gaps, right? And also, if you guys have the time, right, learn more about such concepts, right? It will give you the confidence and knowledge that you need. All right, and always try to backtest your strategy. Okay, so last but not least, the benefits of a trading journal will be performance analysis. You can see how well you perform on different days, right? And also learning and development, right? You have gained a lot of knowledge. If you have a trading journal, right, you decide, you can know what works for you and what doesn't work for you. And the third one will be emotional awareness, right? You know that you shouldn't revenge trade, you shouldn't overtrade, right? And also you can practice risk management, right? You have, let's say, a target of 3% a day, right? And your max trades that you should take would be 2 trades, okay? And let's say for your stop loss, let's say you're not on a prop firm, right? You are using your own account. Per day, you should, let's say, risk maybe 3%. Your target can be 6%, right? And then for your trade planning and execution, right, you will be able to improve so much better on your execution, and also because of the way you plan your trades, right, you are much more careful and you can learn a lot more by tracking it down, right? It takes quite a lot of effort to actually have a proper trading journal, right, on a day-to-day basis, right? But sometimes you don't even have to trade on a daily basis, right? You can do it like maybe 3 times a week, right? I would say there are strategies that maybe if the all criteria are met, you would only enter maybe once a day only, right? Maybe your Asia session, that kind of trades. Okay, so also you can have accountability and discipline, right? And lastly, building of confidence. Okay, so let's see. Alright, so I think this is the last part. Okay, so any Q&A, just type it in the live chat below and I will answer them. Alright, if not, let me just show you guys a quick strategy for Asia session. Right, just a very quick one, and maybe if you guys have the time, test it on a daily basis, right? Okay, let me see. Okay, just give me a moment. Okay, let's see. Okay, let me show you guys. This is for, okay, so this is for gold. Let me try to make a copy. Okay, let's see. All right, gold. Okay, let's see. Let me just clear this for a bit. Okay, so there's this strategy, right, where you can test it out. Let me just show you guys. Let's see. Oh, am I not able? Do I understand correctly? In MT4/MT5, you can add a trading stop that follows a moving average or other indicator. Have never seen that. Oh, okay. So for no, you have to manually add your trading stop. If you want to have such an indicator that helps you to add a trading stop, right? I think you might need to pay for that, right? Because it is using a expert advisor, which is a software that shows you that indicator, etc., right? So I think personally you might need to pay for that kind of indicator. Okay, so Bob, yeah, I would suggest to do it manually. So let's say you have a, let me show you guys an example. Let's say you have a buy entry right here. Okay, let me see. Entry. Okay, and then your stop loss, let's say below this low right here. Your stop loss. Okay, so let's say each time price moves up. Okay, let's say each time price moves up here, right? You will have a trailing stop loss right here. You will have moved your trailing stop loss right at the low right here. Okay, so to prevent yourself from losing profits. Okay, all right, let's see. Okay, so let me just share a quick strategy, right? It happens on let's see, UTC. Let me just change it real quick. Singapore. Okay, UTC +8. Okay, we will mark out these two levels right here. It is 8 AM to 10 AM. Okay, 8 AM to 10 AM, and we are looking at the 15-minute chart. Okay, so just a very quick one, right? So once priced is right here. Okay, so we are at the 8 AM mark. Okay, so we will mark the highs and lows of the 15-minute chart. Okay, we will mark the highs. We will mark the high right here, and we will mark the low right here. Okay, and let's see whether price takes out the 15-minute high or 15-minute low first. Okay, so let's see price. Oh, okay, it took out the 15-minute low. Okay, if it takes out the 15-minute low first, then we are looking for buys. Okay, so let me just take out this. Okay, let me refresh. It's right here. Okay, so we are right here. Okay, then since it took out the 15-minute low, okay, we will switch to the 1-minute chart. Okay, right at the 1-minute chart, and we are back to this time range, right, between 8 and 10 AM. Okay, so what we are looking for after price takes out that low, right? What we are looking for after price takes out that low, we are looking for, let me see, where is my tool? Path. Oh, path. Okay, we are looking for a shift in market structure. We are looking for a shift in market structure over here, right? Okay, once we have this shift in market structure, we will enter on the breakout of this candle, right? We have to look at a full body closure above this level over here, right, before we enter for buys. Okay, and our entry would probably be let's see, where is my square? Okay, we will enter probably right about this area. Okay, and our stop loss will be below, oh, sorry, it should be long position. Our stop loss will be below this low right here. Okay, and our take profit will be at least 1:2. Okay, so just a quick one. Let's see how this plays out. Alright, so we are looking for buys right here, right? So we need a proper shift of market structure. Okay, so let's see right here. Okay, so we have a internal shift of market structure right here. Let's see, where is my arrow? Okay, we have a break over here, a full body closure, which is this, so we are entering on the breakout over here. Okay, stop loss below this low, right? You can put it slightly below. Okay, and your take profit should be 1:2, right? And very nicely, right, price touched our take profit target over here. But based on spreads, I think it might not actually hit our TP, right? But if you are able to go for that 1-for-1, right? If you are this strategy is either 1.5 or 1:2. All right, 1:1.5 or 1:2. A very quick one. All right. If you are not confident about this market structure shift, it's okay, right? You might not enter on this, right? You might actually enter on this instead, right? So we must have a bullish candle body closure, which is here, and then you might want to enter is a buy position. Okay, stop loss placed below this low. Let's say if it's about 8 pips, you'll put it at 10 pips around there, right? Then you're going for a 1:2. Okay, so this only happens at around let's see, yeah, UTC plus 8 a.m. Okay, so this is Singapore time, 8 a.m. until 10 a.m. Alright, you can test out this strategy on your own and have these strict rules in place, right? Test it every day, right, and see how it goes. Usually it has about a 60 to 70% win rate from what I've tested so far over the past month, right? Every day I've been testing it out, right? So yeah, just a very quick strategy for you guys to take away. Okay, all right, so yeah, that's the end of today's webinar. Hope you guys learned something new about how to manage your risk, most importantly, okay, and also to have a trading journal, right, so that you can track your trades and to test it accordingly. All right, so thank you guys for tuning in to today's webinar. I hope you guys have learned something new, and I shall see you again next time. All right, thank you, bye bye. Welcome, no worries. I'm glad you did. Take care. Bye bye.